All right, ladies and gentlemen, we're back onto the John Gill Podcast Show, episode 10, with my great friend here, Ryan Cotter. He is the market leader of Movement Mortgage, a top mortgage firm here in Chicago. He is also the chairman of the National Real Estate Boxing Association that talks real estate, boxing, and helping those in need. He is also the chairman of the LA and Chicago Real Estate Rumble. It's a lot of stuff, Ryan.
I like to keep busy.
That's right. So why don't you go ahead? Oh, before we start, we want to thank our partner, Element Studios. That's EL3, MENT Studios. They're a full-service media production company here in Chicago. Go ahead and check them out at their Instagram. Again, that's Element Studios, EL3, MENT Studios. Ryan, how you doing?
Good. How are you today?
Good. How's your day, man? How's everything coming along?
It's starting off great.
Great. So tell us a little bit about yourself. You're doing a ton of stuff here. You're in the mortgage business. You're the chairman of the LA and Chicago Real Estate Rumble. How do you manage everything? Tell us about each facet of the business. Tell us about the mortgage, the boxing. We want to hear it all.
Well, I think they kind of like dovetail fairly well together. It is majority, real estate lending, construction based. My job at Movement is market leader, which is basically running the state of Illinois for Movement. Movement is an amazing company that very few people in the Midwest know about. They're a number 7 purchase lender in the country, and I actually sought them out when I heard about their story and their culture, and like made it a mission to bring them here to Chicago. They have a from top to bottom, like a completely different company, that anybody's seen in the real estate industry. It's 50% owned by a foundation, which means 50% of the profits go to charities right off the bat. You don't hear that ever, right?
No, not at all.
And so I thought in this landscape, it would be a good fit for me and Chicago, because before I brought them here, I was already doing that. I was dividing my time up between real estate work and charity work. Mm-hmm. And this company kind of like, has the same foundational beliefs. So it was just a good match. And so I've been excited over the last year just to get their name out in the real estate community. And, I'm also using one of my charity events, the Chicago Real Estate Rumble, to, use it as a springboard to get their information out. So to talk about the Rumble, we just actually completed our 3rd Los Angeles Real Estate Rumble last week, about a week and a half ago. And it was a huge success, not to mention just a super fun time. Like anytime you get real estate agents and lenders punching each other in the face for a great cause, you just can't beat that. So we're 3 successful years in Los Angeles, 6 super successful years in Chicago, and 2 years in Toronto. And next year we're expanding to Charlotte. So the goal is to have them in all major markets, as many as we can put. And then we're going to have a championship like in Las Vegas, where it's like the country's toughest realtor, right? The country's toughest mortgage lender, right? And so we got some goals and visions, and the bottom line is that the proceeds benefit at-risk youth programs, such as Big Brothers Big Sisters, Mercy Home for Boys and Girls. Whatever community has like a strong program geared towards mentorship of youth.
I love that.
We want to help support. I believe that's firmly like the number one problem across the country, if not the world, is having mentorship. I think the South and West sides, we've talked about this. Like how do we improve them? And I think that is like through these programs, getting kids positive role models to look up to, and then from there, like there's a bunch of other steps, but that's step number 1.
That's creating the foundation. And you said it just as you said it best. The mentorship programs are so important. Anywhere you hear in business, you have to have a mentor, and it should be the same, in life. Growing up,
you have to have many mentors.
Many mentors.
Many mentors. But the first one is important, and I think most at-risk youth don't understand that, right? There's an old phrase, when the student is ready, the teacher will appear, right? Once you recognize that you need, a teacher, it's real easy to find them. And then you could be, laser focused at getting that one. And then when you get one, you realize, well, no, I like, coaches, right? Michael Jordan, he had 5 coaches, strength coach, Phil Jackson, from, a pastor at your, church, to, whatever aspect of your life, it should have a coach and something to achieve or focus on to achieve.
I love it. I love it. That is amazing. And that falls in line with the movement mortgage and their philosophy. And I can see now how everything comes together.
Yeah.
What do I do to start training for the next boxing championship? How does one
funny
get
that
even?
You mentioned
how
that.
do we get involved?
Let me do an advertisement for the 2020 Chicago Real Estate Rumble, which will be in May of 2020. We're actually going to be opening up fighter registration this week. So
perfect timing.
Put the donut down, get off the couch, get on your phone, sign up. Our tagline is, if you have a desire to give back, want to get in really, really good shape, and possibly have a grudge against somebody in the industry, you're perfect. Sign up, right?
That's great. That's great.
Commission disputes, closings delayed, something that has irked you and you want to resolve it. Settle in the ring, raise some money for Big Brothers, Big Sisters, and Mercy Home for Boys and Girls, and you'll be in that best shape that you've been probably since high school.
That's amazing. I want to sign up. I want to sign up because I'll tell you what, we're just coming in from the long Thanksgiving weekend, and that's a perfect reason for me to get back into shape.
Nothing motivates you more than somebody trying to separate you from consciousness.
Exactly. So tell us a little bit more about your role then at Movement Mortgage. You're the market leader. Tell us, kind of shifting gears now from the boxing to the mortgage. A lot of our audience is also looking for, we have a lot of entrepreneurs, a lot of investors that listen to the show, and people who are just beginning in the real estate industry.
Right.
What do you recommend to them? What is the first thing they should do if they're looking to buy
anything?
Right.
So I say this a lot because I've done this. I bought my first building 1 year out of college, where all my friends were like, "What are you doing? That's like super adult." Like in college, you would never think that I would be doing anything adult like. My friends, they would still crack up like, "Cotter's successful? What?" Yeah. But so, and even in college, like I knew before I went to college, like what I was going to do. I was going to own property, and then in college I got an internship and understood about banking. I was like, oh, this is perfect. This is getting another dovetail that kind of works out well. I get to borrow myself money. This is fantastic. So I bought my first building, fixed it up, rented out the other units, and rented out a couple of the bedrooms actually to college buddies. So I was cash positive from day one. And that's what I recommend, right? So I put together this, what I call the 4, 3, 2, 1 steps to financial freedom, right? The biggest expense that you're ever going to have in your life is your housing expense, right? There's just a natural cost to having a roof over your head. So if you follow the system, you'll never, ever have that anymore, right? And so when you do get to that single family, and I show people how to do this with low down payment programs where you get in like, I don't want to say with no money, but shockingly low amounts of money. And what you do is you create income producing assets that when you go from the 4 flat, so you buy a 4 flat first, you live in one, you rent out the other 3, you have no monthly obligation. You don't go spend that money that you were going to typically have for your housing payment, you save it, right? And then you, over the course of a year, 18 months, now you have money for another down payment. So then you buy a 3 flat, right? Live in one, rent out the other 2. The cash flow from the departing residence, your 4th unit, now covers any shortfall. Then you buy a 2 flat, and then you buy a single family or a condo. When you get to that single family or condo, the cash flow from the 3 other properties cover the mortgage payment. So you've eliminated your housing payment forever. You have income producing assets that are going to pay themselves down and be, part of either part of your retirement portfolio. It could be your springboard into something else. Even if you just buy a 4-flat and then go to a single family, or condo, that's fantastic because it might not be for you. It does require work. This is not a get rich quick scheme. This is get wealthy over time. And it's proven. There's a billion books on the internet that tell you, this is what you should be doing. I just give a little more clarity in the back end of understanding where the money is coming from and the best sources and uses of that money to just help you do what all these books tell you to do.
It's amazing. So that is phenomenal. Most people out of college or most people looking to get into real estate are looking at a single family home.
To begin with, and that's the worst thing to do. Depends on what you want to get into, right? If you want to come home and just take your shoes off and never be worried about anything, condo, single family, absolutely, right? It's better than renting. So I tell people renting is bad unless you rent from me, right? So first, renting versus buying. Buying makes sense. Renting versus buying a 2-flat makes more sense. Renting versus buying a 3-flat makes even more sense. Renting versus buying a 4-flat makes the most sense, right? And understanding underwriting is the key to this because most people think, I want to buy that condo single family first, right? Then I'm going to get into this multifamily thing, right?
Right.
And you've just, by doing that, you've shot yourself in the foot because the key here is the owner occupancy piece. So if you can live in there, FHA or even conventional programs will let you get in with the absolute lowest down payment. If you do it flip side, where you buy the condo single family first, then they're going to require you to put down 20 to 25%. So you've created a barrier to entry that is just too high for your average person to do at any point in time.
I love that you mentioned that. Because the second they buy that house, it's out of the equation. You can't go from the single family to the 40.
You can, but you have to sell that condo and start over.
Right. Or like you said, you have to, meaning you're not going to be able to take advantage of the 3.5% down payment option. So you can finance a 4-unit with 3.5% down.
Well, technically it'll be less because here in Illinois, you get a tax proration.
Okay.
So you could show, and I show people this, not only could you get in with less than 3.5%, technically somewhere around 2%, but we can also give you money to fix up the place on top of it. And that's the graduate level.
Explain that program. What is that program called?
So a long time ago, they used to have these things called newspapers, and when you opened them up, it would break down sales of single families, condos in 2 to 4 flats.
Okay.
Right. That was in the Tribune all the time. Right. Okay. I've not seen that for forever. Right. And so this product has kind of been forgotten. That's just it. There's a super cool thing they call the FHA 203K, which is a acquisition rehab loan that's been around forever that people just don't talk enough about.
Yeah.
So a lot of people use it for single families. They find something that's not perfect and they want to fix it up, replace a kitchen, replace a bathroom. But when you apply this to a multifamily, well, now you think about if I clean up kitchens and baths on apartments, I'm going to increase the rent, right? So you're adding value and you're increasing your cash flow, and you're doing it all with the lender's money, right? So all you're putting in is legitimately sweat equity, right? Because you're doing it and you're being there, you're acting as project manager, general contractor, whatever, and you get paid for that. You're adding value, right? And that's going to go to your bottom line. Yeah. It's going to be money that increases your rents, which is taking care of your housing payment and potentially cash flowing. I have one of my longtime friends and clients was an older lady. I've known her for about 20 years. She was 50 at the time, and she saw that I was buying buildings right out of college, and I was lending. So she first worked as one of my referral sources. She was a real estate agent referring people to me, and I was like, "Hey, you should do this." And she's like, she owned a condo in the Gold Coast, right? 50-year-old lady owning a condo in the Gold Coast, and I had to explain to her you need to sell this, right? And she's like, No, right? But over like a little bit of time, she bought in. So she sold it, and she bought a 3-flat in Old Town, right? She bought it for like $550,000, right? Which at that time was a lot, but that place is worth like 1.7 right now.
I was going to say,
yeah, right.
That's a great price. Yeah.
And on top of it, she has not had a mortgage payment for 20 years because the rents have covered it, right? And now she's got a bunch of equity. She's not had, she's upset about the taxes and stuff like that. And, like, oh my God, like she was cash positive. Now she's break even because of the taxes. But she's got like her structure is like 2 houses. So she got a single family home in the front, and she's got some rentals in the back.
It's like a coach house.
Yeah. So the coach house is the rental piece. Right?
I see.
So I was like, you live in like Old Town in a single family for the last 20 years without having a housing payment. Like, you are a success story, and you have a bunch of equity. So that's what I tell people. Like if you do that condo, you can start over. But you got to be willing to do that. Like, you can't have like 4 kids in a single family because they're really not going to buy in. So your opportunity is up front, and buy that like as your first building. Again, I can show you ways to buy even more, or that one property might be the only one that you ever buy, and then you go to a condo, but that's an asset. That's, your home is a liability. It's not an asset, right?
Absolutely. That is a success story. And I think after hearing all of this advice, there's going to be many success stories after this. Now, 4 units, 3 units, 2 units, and then a single family home. What if you buy a 4-unit and you're looking to buy another 4-unit? Can you?
Yeah.
Okay. So
it's just got to make sense. And so working backwards, and I explain to people like, listen, you got to understand the rules of the game to play with them. So I buy a 4-flat for $400,000 because that's what I qualify for. In a few years, my income goes up. The next one that they would believe that you would live in, so you don't have to put 20 or 25% down, would be something that either has like some or many different attributes that make it believable that you would live there, right? So price point could be one. So if I bought a $400,000 4-flat, if I'm looking to buy a $600,000 4-flat, that makes sense, right? If it's closer to work, if it's closer to a relative, there has to be some compensating reason why it makes sense that you would live there to, again, use the low down payment programs. But if you have those, there's no problem with it whatsoever.
And what are the loan limits there? I mean, on a 4-unit, if you're starting off at $400,000, then you're going up to $500,000, and maybe you find another one for $600,000.
Right. Right now it's $707 for a 4-flat with FHA's, whether it's a 2 or 3K or standard. But that's probably going to go up in the next couple of weeks. Fannie Mae and Freddie Mac just raised their limits. So I would take a guess and say it'll probably somewhere be around the 750 range, which is, that opens up, a lot of areas and opportunities to
absolutely
add value or buy something that's turnkey and just, get, one step closer to being out of the rat race.
Absolutely. And what about the interest rates? Because not only are you taking advantage of this low down payment, you're talking
sick low.
Yeah, on a 30-year amortized loan.
Yeah.
So how low are we talking about?
So
today's what?
I tell people all the time, like, if they let me borrow $1 billion, I'd buy up everything in the city of Chicago because you put it on 30-year fixed money. You set and forget it. Your rents are going to increase, right, over time. But even if they didn't, you have somebody paying down the debt, and on top of it, you get a tax deduction. That you can, basically take Uncle Sam's hand out of your pocket just a little bit, right? So the write-offs that they afford you, everything is just, it's a beautiful, beautiful thing if you understand all the different pieces that you can leverage and that you should take advantage for. It's not for everybody, right? Being a landlord, is, it's work. Right. Again, I always go back to it's not get rich quick. It's not a scheme, not a scam. It's a plan, right? That takes time and effort. So you're going to get, phone calls but it's easier now to deal with that clogged toilet with, that tenant that thinks there's something wrong with electricity and it's really just the light bulbs are all burnt out. Right?
I've had that.
Yeah. And I think, as a landlord, we all know that. We go through that. And then we troubleshoot, before we even get out there, nowadays with the tenants, when they call up and they say, hey, this is going, You have a series of questions because you experienced already, and you troubleshoot over the phone, and you say, okay, is that only one room the electric is out, right? Okay, have you changed the light bulbs? And they'll be like, no, change the light bulb, and then call me back. And they're like, yeah, it was the light bulb, right?
Unbelievable.
But you used to have a bunch of trusted tradesmen, like you had to have a crew, right? Not the mafia crew, right? Legitimate people who could like do work, right? And you trusted them not to take advantage of you. Well, now with all the online resources, Fixit.com, Tackle, Angie's List, these resources are there and they're already pre-vetted about what the repair costs are going to be. So, the days of knowing that trusted a plumber or trusted, carpenter or electrician, there's so many resources that, hey, when the plumber gets there, FaceTime me, right?
Yeah.
And so I can watch him, right?
Yeah, exactly.
You don't have to be the guy that spends an hour and a half going someplace. There's enough, ways around it that it's a lot easier than when I started, when you started doing this a long time ago.
Absolutely. And now, so anyone that's looking to take advantage of that, I think that's the best type of program, the FHA 203K. And then explain to us a little bit about some of the other programs that exist on the marketplace. You've got jumbo loans, you've got conventional loans. What's the difference between each one, and what are their benefits?
So quickly, FHA loans allow for low down payment. They have that acquisition rehabilitation component. The drawback of FHA, so go through quick pros and cons, is that it has mortgage insurance, and the mortgage insurance stays with it for the life of the loan. Mortgage insurance is bad. It's never tax deductible. So I tell people, like, when you're adding value, you want to get quickly to that 80% threshold so you can eliminate the mortgage insurance and then refinance into a conventional loan. Conventional loans have a slightly higher interest rate than FHA, but lower than the blended rate when you factor in rate and mortgage insurance, right? Another component is that FHA, you can only get one FHA loan, right? So, I call it basically a tool that you use, to acquire these properties, right? So you'll use the FHA loan to acquire and improve, then you refinance into a conventional loan. You've freed up the FHA loan to use again, and you can do this multiple times. Conventional loans, you can actually get 10 of them, right? So why not get 10 properties?
Wow.
That's my personal preference. I've done it. And then from there, it could be your springboard to looking at bigger projects. You just don't go from buying a 4-flat to buying a 20-unit building, right? You buy a couple 4 flats, and you manage 12 units, and then your next progression up makes sense that you go to like a 20-unit building. Then you can do a 40-unit. Then, the sky's the limit after you basically learned and you're prepared for the next step in your evolution.
Absolutely.
So conventional, and then jumbos, that's where like the mortgage is, higher than the conventional cutoff limit for all those different properties. So it's just more money. There's more risk technically associated with it. So the interest rates are sometimes higher, and they have different features. Right.
Got it. Okay. That's a perfect explanation, because there's a lot of different loan products, and someone just looking to get involved, not knowing where to start. I think that helps explain each one adequately and very thoroughly. So you can pick up about approximately, using the FHA program, because I want to go back to that, the quickest way to kind of add units to your portfolio, and probably the best way, in my opinion, is what you said earlier. Approximately how many units total can someone approximately how many units can someone pick up using that program? And for someone also saying, well, my income really isn't that high. I was only approved for $150,000 on a single family home. Where am I going to find $150,000 4-unit? What do you say to them? Because the reality is you can actually afford a higher purchase price, right?
Right. So that's a
that.
base. So a couple of quick rules of thumb that I tell people. Like, number one is that whatever your annual income is, whatever you tell Uncle Sam you make, you can use a factor of like 3.5 to 4 times that, and that's what you can afford to borrow. So if you make $50,000, right, 3.5 to 4 times, you can afford about $200,000 to borrow on a single family. When you factor in that there's you get money coming in from the multifamily, that's rental income that gets tacked onto your income. So the multiple sometimes jumps up to like 7 to 10 times of what that income that you reported to the government because of the rental income. So I have a bunch of examples where, people that were making $60,000 because of that rental income qualified for a $580,000 3-flat or 4-flat, right?
Wow.
So that is, the first step is, okay, let's find out your base, and then let's, where are you looking, right? Where would ideal situation be for you to find something? And then we can work backwards at what the rental income for, that specific zip code is.
That was my next question.
And then, we factor that onto your income, and then we factor what property taxes are. It's more complex than just, going online and getting pre-approved. Ours requires a lot more steps, but there's a reason to it.
So it's not just the stated rental income. You're going to look at, obviously, the market comps. I mean, let's say that the existing property has lower rents than the market. Are you factoring that in? Or you're
using the market.
You're using the market.
Right.
So if they're okay. So
because a lot of times you'll have long-term tenants.
Right.
And one of the challenges that we overcome, all the time, that's, a lot of people just don't get this, right? So I run into a lot of times where, sellers and listing agents are afraid of certain types of offers because they've had them fall apart, not because of the actual program itself, FHA or FHA 203K. It's about the person that was, entrusted with that loan doesn't do it a lot and just thinks it's pretty turnkey, where it's super, super specific. So I have to go in and basically handhold listing agents and sellers and go, listen, this is why the previous transaction didn't work. This is what we're going to do differently. This is because we know these roadblocks, these little nuances about market rents and how we have helped the listing agent, explain what the market rents are to the appraiser, right? And all these components that, just make it a seamless process, as opposed to somebody just doing it once or twice and, stumbling across the way. So, if the only tool you use is a hammer, everything looks like a nail, right? If you know specifically that this thing is going to pop up, and I tell the listing agent, hey, this is what you need to do when it comes time to the appraisal, right? Because properties don't get sold at full market rents. Very few, and not enough for comps, because you need 3 to 5 comps, right? So what we need to do is give the appraiser market rents, and basically it's just a step of having them create CMAs for each one of the rental units, what the market rents are, because appraisers are fantastic individuals of assigning value. They know that. That's their job. When you ask them to do the rental component, they're not rental component specialists. So that's where they actually rely on the listing agent for more information. They will openly accept it. Typically, when an appraiser goes to a property and the listing agent, here's all these comps. They're like, throw this out the window.
They toss it out.
They're like, I mean, they're courteous, like, oh yeah, thank you so much. But they're back in their head, like, listen, I know my job, right? But and I've talked to many appraisers about this. They're like, that rental component, we're shooting blind, for the lack of better words, because it's the information out there isn't specific enough. So all we do is we help the listing agent give specific information that helps the appraiser. The appraiser is 100% grateful for it and is like, I get it. Thank you. Right. It's the one time where appraisers and listing agents, collaborate. Right. But that's it. And so those components, there's a lot more, but that's just one that I kind of highlight, because when I explain to listing agents, and sometimes I have to explain to sellers, no. This person could put more money down. We're telling them not to, right? We're explaining why it's a benefit to leverage this financing, and they'll be like, okay, this guy knows what he's talking about. All right, we'll give it a shot. And they're all skeptical, and then it closes without an issue, and they're singing our praises and saying my last testimonial legitimately was, Ryan Cotter's the boss.
There it is.
Yeah.
Well, that's why you're on the show, because you are.
Yeah.
And I mean, that information you're providing is just amazing. It's any seller out there listening to this, don't worry about getting an offer with an FHA pre-approval from Ryan Cotter, Movement Mortgage.
But in the same token, if you get it from somebody else, make sure you have that conversation, because you'll be able to tell. There's a lot of really, really good mortgage professionals that would stumble on this, right? So I would say if it's a very, very specific product, get some questions across to that person and just say, like, listen, I've had problems, and you at least get the reassurance. More times than not, that loan officer is, of course, he's going to say, "Oh no, I got this." But then,
find out real soon.
Yeah. And worst case scenario, I legitimately save deals every month from people that said, this couldn't get done, and like, I chuckle. I go, I'll have it done in 30 days.
Awesome. So I love the FHA program. The 203K sounds amazing. And for a 4-flat, though, you're talking 4 separate units. If they all need renovation, are there limits to how much that renovation loan is? Is 203K capped at a certain construction loan limit? And if it passes beyond that, is there another type of product?
So FHA, it's the same for the 203K or just the straight acquisition.
Okay.
So 700,000. If I found something that was valued at 400,000 right now, and I could put $300,000 into it, and bring that value, and that thing would still appraise out, then you could go up to 300,000, right? So it's an equation of both, acquisition
Totals.
And construction underneath the FHA loan limits. So that's for 4 flats, for 3 flats, 2 flats, and single families. Above that, there's standard, acquisition construction loans, which require significantly more of a down payment. But those are out there, and eventually, what I tell people is, like, as soon as if this is a path that you want to go down, and you acquire all these properties through FHA 203K and refinance them with conventional loans, and so you have this nice portfolio. Eventually, they're going to say you're not going to be approved for the next one, and that's basically, congratulations. You've done a fantastic job of leveraging as much of the cheap long-term fixed money as you possibly can. Now you're going to have to go to this, basically the standard stuff, which by this time you would have a nice nest egg that you could potentially cross-collateralize with a bank, because now you're going relationship, right? You're cookie cutter up until the end of that. Then you're going to go, sit down with a good old-fashioned bank, say, let's make a relationship, and they're going to be your bread and butter from then on out.
But that's a great journey. I mean, just with that alone, you're talking you can acquire 12 units, even possibly more, depending on...
No, if you do... So that's my 101 class is 4321. And we kind of touched on this. Like, if I buy a $400,000 4-flat, then I buy a $600,000 4-flat, and then I buy a $700,000 4-flat.
That's 12 units.
That's 12 units right there. Then I do the three flats, and 3, 3, 3. So I call it my 4, 4, 4, 3, 3, 3, 2, 2, 2, 1 at the end. Steps to financial...
It's like 27
success.
units.
Yeah, 30 units.
30 units.
Yeah.
Amazing.
And
throughout, so you're having hopefully now you're down to your 1, your single family. That cash flow is taking care of ideally the mortgage payments.
Oh, it is.
The cash flow, it cash flows.
Again, you could do it with the 4-3, the 4 to 1, the 4-3-2, 1. Those all cover that mortgage payment.
Sure.
I've done that, right, without question. When you do the 4-4-4, 3-3-3, I mean, you're generating like a lot of income.
Yeah.
And the key is, like, as you do this, you keep your day job, because you need that for the leverage to finance. But at that point in time, you're a real estate developer, right?
Sure.
You're a true landlord. And usually most people that do that, they take it to another level, right? Because they have the experience. So I see people reaching new levels, always wanting to do stuff. Take your time. Don't rush in. It's not going away. Just exercise some restraint, because the first thing that somebody says to me right after they close on their first building is like, when can I buy my next one? Like, take about 18 months, right? Or a year, right? If a deal pops up, we'll talk about it. But, take your time and then save. So the two things that I tell everybody are prerequisites for doing this is reading Rich Dad, Poor Dad by Robert Kiyosaki and The Millionaire Next Door, right?
Awesome.
Those two books will give you a foundation to understand what the steps are in this, like you said, journey, right? To creating, generational wealth that you pass on to your children, right? Yeah. And I think we've talked about this a few different times, and I won't say what I typically say, but this will help children. I think that in a society where there's a sense of entitlement. I've seen this firsthand in in my life in college, where I ran into kids that were first generation college goers. Their parents were immigrants. They bought buildings, and they picked up everything quicker. They picked up accounting quicker. They picked up marketing because they knew. They picked up management. They knew because they were born into business, right? Because their parents had them. They saw their parents working, and sometimes it has two different effects. First is that's exciting and motivational for me, where like when I get out of college, my dad's going to give me a building. I'm going to manage it. That's going to help me as my launch pad for really. Number one, it pays for all my college. It pays for like my wedding, my new house, all that stuff. Or depending on how involved the parents were, because I use this in my life right now, is sometimes it's like a big detriment. Like I hate this property because it kept me away from my parents, right? So as I do this, I always make sure, and I tell people without question, I have two now awesome little guys at home. And
congrats.
Yeah. I hate leaving in the morning. I can't get home fast enough.
I'm
right.
with you.
So, and I don't think that'll ever change. And now I've integrated them into it. So my largest one, who's 4 years old, I'll show you pictures. Like he's got his own Home Depot apron. he's got
That's amazing.
He legitimately likes to do the work too. Like I had him like spackling.
That's awesome.
And he loves it. He loves painting. Yeah. He's got like his like little toy saw and drill. Awesome. And he's completely engaged. And some of the benefits of doing that were that I saw that from his problem-solving skills, it really, he's been on a construction site since he came out of the womb. Yeah. So I remember we actually have pictures like at the very stage of the construction. And when we took him to daycare, he was putting together Legos and blocks like nobody's business, right? Because he saw things kind of like assemble.
Awesome. Yeah.
And what they've told me a couple different times, because now he's in school, that like his problem solving ability is far advanced, right? And so his engineering mind is already working, and like he had to get tested and to go to preschool. How crazy society is that we live in. That gotta test a kid. Like I was like, what are you gonna test this kid about? Like like he's 4 years old. Yeah. Right. What can he do? Like, oh, no.
Can you draw a circle?
Yeah. So we were worried. We brought him in and we saw like, they're like, okay, well, they used, the problem solving was blocks. I was like, oh, he's going to crush this. And they're like, and not only did he crush it, they're like, wow, that was fast. Like
he's built a skyscraper.
Right.
That's amazing. That's awesome. No, definitely. That's, I love how you're right. What we do in our business definitely transcends deeper into family and hopefully has a bigger, meaningful impact with our children. Ryan, I know that we've talked a lot about the 203Ks, but I do want to say I want to go back to that. Someone looking to take advantage of that rehab loan and has an uncle who's a contractor, can he do the work for that investor? Or is there a rigorous kind of
there's a vetting process? There's a vetting of course, and when you're leveraging this, this type of of money and high loan to value, there's a lot of safeguards, right? And you're not going to be able to kind of like don't abuse the system or don't even try to think about it, right? The short term gain versus long term goals, is what you should be, focused on, right? But then there's also the flip side. Like, I know my uncle is going to do the best job. He's going to give me the best deal, right? He's a licensed contractor, licensed, bonded, has a good, right? Got everything that checks out. Absolutely. No one's going to, nepotism is a good thing, right? You cannot be your own contractor, right? Because that would be a conflict of interest, right? So, there's a 100%. There's a vetting process.
Okay.
Play by the rules, and and this thing will be a launch pad for your financial freedom. Awesome. So just do that. I tell it to people, understand the rules and play by them. Just maximize them.
Okay.
Right.
And the other point I wanted to bring up was, what about those that say, I don't have that much money saved up in my bank account. I'm making good money, but my savings isn't all there. But I do have a rich uncle, that's willing to lend me or gift me the money for the down payment. Is that possible? What are the restrictions?
Yep.
What are
you
the
can
limits?
get FHA. The beautiful part about it, that's another one of the components, is you can get a 100% gift. So we have a lot of times where the kid has talked to the parents about this. The parents are somewhat excited, but sometimes skeptical of the children. I've seen this happen a bunch of times, right? Where now, they gave the kid the down payment and watched them do this and then do it again. And then the third time, mom and dad are like, we want to invest with you, right? We want, this is your thing and you're good at this, and we want to invest with you. And so I've seen that happen. And yes, you can get a gift, 100% gift. So if you don't have that money, but you have the access to somebody that would give you that, awesome. And later on, if they're investing in you, you're paying that gift back. You're giving back to them. I have a great story about an AT&T worker that came over to my house, and he's like, "Man, this is a big house." And I'm like, "Yeah." And he's like, I don't think that, I look that old. So he said, "Hey, you look pretty young. How do you get this big house?" And he had a 4-year-old son that we started talking about. I saw the guy buy buildings and fix them up, and this is my thing, and buy buildings for my kid, and long-term plans. It's like, I totally want to do that. I was like, well, then I just go into qualification mode. Like, all right, so you work for AT&T, so I know you got the job. Check mark, right? How's your credit? It's not that great. What's your credit score? 620. I was like, good enough, right? You're like, what's the next thing? How much do you have for down payment? I don't have enough. I got to save up. How much do you have? $10,000. I was like, that's more than enough. I was like, come in on Monday. I'll get you pre-approval, find you a building right away. We did. Found him a 4-flat, West Humboldt Park. And it was a $300,000 purchase price. And he got in with the total with seller credit towards closing costs and the proration for $5,000.
Wow, unbelievable.
Yeah, so basically 1.5%.
That is phenomenal. So anyone who just has the desire to buy, just give Ryan a call.
Income. You need a job.
Okay. Well, yeah, you need the job.
This is not like those fortune builder programs, or we're gonna help you become we're gonna help you become a millionaire. Give me $20,000, right? No, this is like, let me give you the money. Have a job, have decent credit, down payment.
How long on the job?
6 months.
6 months. 6 months.
Yeah,
that's it.
Mm-hmm.
Now. Okay, so I thought it was 2 years of tax returns.
So for certain people who are self-employed.
Oh, that's why you were asking for myself. All right, let's go.
You need a history of consistent income, right? When you're just a straight W-2 employee, that consistency is kind of like built in, that you're going to be making this for the next foreseeable future, right? If you're self-employed, your income could fluctuate. You could take advantage of write-offs, all sorts of stuff. So when that type of individual, so I specialize in the complex and the construction. A good percentage of my clients are self-employed, vicariously by buying real estate. So I understand taxes really, really, really well. So that's just the reason, so an underwriter, needs to look at consistency, because that's what lending is based on. The fact that you're consistently making income, that consistent income is what they use to figure out how much you can borrow.
So 6 months if you're a wage earner.
Yep.
You got to, okay. That's great that you mentioned that. I've had some, okay, perfect. All right.
Light bulb.
Yeah, 6 months. And, okay, so, and then one other thing, any seasoning requirements for the down payment? Seasoning is, and can you explain what seasoning is?
So if it's gift, no, there's no seasoning requirements. I mean, you get it right before closing.
Okay.
In certain programs, seasoning means like a set period of time where something needs to be seen in your possession, right? And that goes from seasoning of property, seasoning of money, seasoning of like whatever, right?
Mm-hmm.
So conventional programs sometimes, whatever one, and within these umbrellas of FHA and conventional and jumbo, there's like multiple programs underneath them. Not enough time to even come close to going through a fraction of the different programs.
Sure.
So the broad stroke of seasoning means you need to have something for a period of time before you can actually close on the loan. So there's various seasoning requirements on various aspects of the lending process.
Got it. That's amazing. And another point I want to bring up is a lot of buyers are on the sidelines when they hear a federal open market committee rate, Fed fund rate is coming up. Should someone wait for the Fed to meet in order to refinance? I mean, does that really trickle down to your actual mortgage interest rate?
Yeah, the two components that you touched on. Number one is the Fed affecting interest rates, and I kind of use the analogy like a chocolate chip cookie is not just made up of chocolate chips, right? So the Fed affects affects something, right? But there's so many other components that are involved where you see like the Fed cuts rates, but mortgage interest rates go up. Why does that make sense? Well, because it's more components. Right? That's just not it. Like mortgage rates are based off mortgage-backed securities, which are an instrument on the secondary market and open markets, right? So how they trade is what dictates interest rates. Now that Fed affects that. Inflation affects that. Jobs affect that. Global, interactions like affect that. So everything affects that. That's one component that could affect it positively, negatively. The next is you said something about like buyers thinking about when should I get in the market. I use the phrase dollar cost averaging for a lot of reasons because financial planners talk about it a lot. People understand it, but especially in the multifamily space, when you buy something, right? And people are like, oh my God, there could be a recession. And I tell them like, yes, great. We want that, right? Because it's just a cycle, right? Because typically when prices are high, interest rates are low, right? And then they typically invert, right? When prices go down, interest rates go up. But that's when you buy. And the beauty part about our system is that I can retrade that interest rate at another time when the value has kind of gone up into a lower interest rate, right? So your dollar cost averaging over a period of time. So you're buying all the time, right? And then in the future, because again, it's an asset that somebody's paying down anyways, right? So in 15, 20, 30 years, what you bought here, yeah, it's gone like this, but it's over here. It's higher.
You've built equity as well, and
right.
you've taken
and somebody's paying it down. Right.
And someone's paying it down, right? Someone's paying it down. You're building equity. You're still riding the wave. You're getting the depreciation. So it's a no-brainer.
It is, and again, there's work involved, but the upside is that you have a housing payment anyways, right? Why not figure out a way to get around it?
Absolutely. Well, Ryan, on that note, I want to say thank you so much for just this amazing content you just put out. I know that there's going to be so many people calling and thanking you for the information that you've put out here today.
Thank you for having me.
And yeah, Ryan, if anyone wants to get a hold of you, what's the best way for them to reach you?
You can reach me at ryan.cotter@movement. You can check me out on LinkedIn. And I don't know what my Instagram thing is.
That's all right. We'll place a link.
I'm very low tech.
We'll place a link on the YouTube video. So yeah. But Ryan, thanks again for coming on the show. It's been great. And before we sign off, we do want to thank our partner, Element Studios. Mm-hmm. That's EL3, MENT Studios. You can find them on Instagram at Element Studios. EL3.
Very cool space. I would highly recommend coming. And
Ian, thank
clients.
you so much. Untold Stories Recording Studio. Go ahead and check him out as well. It's an amazing space. So thanks again. I hope you have great holidays. And I will see you at that boxing event.
Yes. The last little plug.
Yeah.
ChicagoRealEstateRumble.com. Go ahead, sign up, get more information, and we'll see you in May.
Do I get to choose who I'm going to fight against?
Because
I got a nice list of people I want to punch in the face.
Yeah, that's actually one of the things we do. We have throwdowns or call outs, like, hey, and then the person knows who they're fighting, right?
Okay.
And then that animosity or let's social media war this out up to the event. That's fantastic. So you can pick somebody. We've had where brothers in real estate have fought each other.
Awesome.
Yeah. A lender and they're like
the rival.
They're real estate agent, right? Okay. Like they're friends, but they're like, I've been wanting to punch you in the face for a long time. This is a way I get to do that, and there's a great cause behind it.
Amazing.
So yeah, let's get that list. We'll start making some phone calls as soon as we get out of here.
All right, that's how it's done. Thanks, Ryan. I appreciate it. And thanks to everyone here for listening. Go ahead and follow our channel if you've liked what you heard today, and subscribe. Thanks so much.